You want to own a data center. On paper, it looks like the greatest landlord business on earth. Google, Amazon, and Microsoft begging for space. Vacancy rates at historic lows. Checks arriving every month from the most valuable companies in the world. In reality, before a single server earns you $1, your entire $2 billion investment survives or dies on one thing: a permission slip from the local power company. Not the building, not the tenants, the utility. And right now, that permission slip has a waiting list 5 years long. That waiting list is where the real business begins. It decides who gets rich, who gets trapped in debt, and who quietly pays for the grid upgrades behind the AI boom. Here is what most people get wrong about data centers. A data center does not sell space. It sells power. Think about what actually happens inside that building. Every server needs electricity to run. Every server generates heat, enormous amounts of it, and that heat needs more electricity to remove. Cooling alone eats between 30 and 40% of the total power draw. Then you need backup generators for when the grid fails, a backup for the backup, and teams watching all of it around the clock, because your customers will not tolerate anything less. Why around the clock? Because your contracts say so. Google, Microsoft, Amazon, they do not sign leases. They sign uptime guarantees. 99.999% availability. That is 5 minutes of allowable downtime per year. One unplanned outage and you are in breach. Penalty clauses, lawyers. And the real cost, losing a tenant that took 2 years to sign in the first place. So you are not building a warehouse with servers in it. You are building a power distribution system. The servers are just what plugs into it. Now look at what that costs. A standard 100 megawatt facility runs between $10 and $12 million per megawatt to construct. For AI optimized builds, liquid cooling, high density power infrastructure, that climbs to $20 million per megawatt or more. A single 100 megawatt AI campus can cost north of $2 billion before a tenant moves in. And it does not stop there. The hardware inside becomes obsolete within a few years. Then you replace it. The building is the shell. The machine inside needs constant feeding. The buy-in is not a number. It is a commitment that never stops compounding. Here is what the customer never asks. Here is what the operator cannot stop thinking about. Picture this. Your building is finished. 18 months of construction. Cooling systems running, servers racked and cabled, fiber lines under the floor. Your tenant, one of the largest cloud companies in the world, has signed the lease and is ready to go. You call the utility to connect the power. They say, come back in 2031, not 2026, not next year, 2031. That is the power trap. And it is the single thing that separates the operators who built empires from the operators who built very expensive empty buildings. Here is why it happens. Your facility draws as much electricity as 80,000 homes. Continuously. No nights, no weekends, no seasonal drop-off. The American grid was not designed for this kind of load. When you apply for interconnection, the utility has to model the impact on the entire regional system. That means new substations, new transmission lines, coordination with neighboring grid operators. Each step runs on its own timeline, its own supply chain, its own bureaucratic pace. The US interconnection queue currently holds over 2,600 gigawatts of proposed new load. That is more than double the country's entire existing capacity. In Texas alone, nearly 200 gigawatts of large load applied for interconnection in just the first quarter of 2026. Google has said publicly it is facing potential connection delays of up to 12 years for some new sites. You can build the building in 18 months. The power takes far longer. So here is what this looks like when it is your money on the line. You have committed north of $1 billion. The building is up. The hardware is inside. Your tenant's lawyers are calling every week, and you are waiting. Not for customers, not for revenue, but for a utility to finish the infrastructure that should have been ordered before you broke ground. The market moves fast. The grid does not. And while you wait, something else is happening in the neighborhoods around you. The utility is upgrading the grid to handle your load. Substations, transmission lines, new generation capacity. Those upgrades cost money. And in most states, that cost gets spread across every ratepayer in the region. Every home, every small business. Every person paying an electricity bill absorbs a piece of the infrastructure built to serve your building. Near major data center concentrations in Northern Virginia, electricity prices have risen by as much as 267% over 5 years. Virginia passed legislation in late 2025 requiring large data center customers to pick up more of those grid costs directly, after years of ordinary residents absorbing them. The residents of Loudoun County, the place the industry calls Data Center Alley, home to the world's largest concentration of these facilities, are paying higher bills for buildings they had no say in building. The business model, at the margin, runs partly on costs other people absorb. That is not illegal. It is how utility cost recovery works in this country. But it is real. And it is why this industry is now facing political pressure it has never seen before. The math works. The timing does not. Follow the money, not to the data center operator. Pass them. 3 groups. 1 boom. Very different mornings. The early power winners. These operators built before the queue existed. They walked into a utility office in 2008 or 2012 and signed a power contract when nobody else wanted one. Construction was $8 to $10 million per megawatt. The interconnection queue had months in it, not years. They had time, cheap debt, and grid access nobody was competing for. They were not geniuses. They were early. Equinix today runs 49% EBITDA margins on roughly $9 billion in annual revenue. It has raised its dividend every year for more than a decade. The building has not changed. The tenants are still paying. The power contract. The thing nobody thought of as the most valuable asset. That is what turned a warehouse into an empire. Their moat is not the brand. It is the power agreement they signed before anyone realized you should fight for it. The late debt builders. These operators arrived after the queue filled up. They looked at the same demand numbers, raised billions in debt, broke ground on AI campuses, and signed tenants. The logic was sound. The timing was not. Take CoreWeave. The company has a contracted backlog exceeding $66 billion. Microsoft, OpenAI, Meta, some of the most important AI buyers on Earth, have committed to spend on its infrastructure. That backlog is real. The demand behind it is real. On one side, CoreWeave has the kind of backlog most operators would dream of. On the other side, it has roughly $15 billion of interest-bearing debt, a capex plan that could reach $30 to $35 billion in a single year, and a grid queue that does not care how large the backlog is. That is the problem. The backlog is the asset. The debt is the clock. And the clock runs whether the grid connection shows up on schedule or not. The input sellers. This is the group that does not care who wins. NVIDIA sold the GPUs that went into every facility. Early operators, late operators, hyperscalers, startups. In fiscal year 2026, its data center division generated $193.7 billion in revenue at around 71% gross margins. They did not wait in a single queue, carry a single lease, or worry about whether any particular operator reached occupancy targets. They sold the shovels, then went home. The construction firms, the cooling vendors, the power equipment manufacturers, order books full, years out, paid on delivery regardless of what happens after. The utilities, regulated monopolies, no real competition, recovering upgrade costs from ratepayers, collecting on every new megawatt whether the building above it is profitable or not. These groups do not have occupancy problems. They do not lie awake wondering when the utility will call back. They just have demand. And at least for now, demand is still there. The strange part is this. Everyone can be right about the AI boom and still not make money from it. Because the boom is the same. The position is not. To see why timing matters, imagine 3 operators entering the same boom at 3 different moments. These are simplified scenarios, but the economics are the point. The early operator. Secured power in 2012. Built a 100 megawatt facility in Northern Virginia when construction ran $8 to $10 million per megawatt. Call it $800 million to $1 billion total. Locked in long-term hyperscaler leases before vacancy rates fell below 2%. No queue problem. Debt service manageable from day one. Today, those margins run around 49%. The dividend goes up every year. The building is the same one from a decade ago. What changed its value was not the hardware inside. It was the power contract underneath. The late operator. Started building in 2023. AI demand looked like it would never slow down. raised debt to fund a $2 billion AI-optimized campus at $20 million per megawatt, signed a tenant before grid access was confirmed. Today, the building is up. The hardware is in. The grid connection is delayed. Debt service runs every month, whether revenue does or not. The tenant is waiting and quietly looking at alternatives. Meanwhile, inference hardware is getting more efficient faster than the lease model assumed, which means the tenant may need less raw capacity in 2 years than the contract was written around. The backlog looks fine on paper, but the window between when debt starts and when revenue starts, that is where operators go under. The input seller sold the GPUs that went into both facilities, collected 71% gross margins on both orders, does not know and does not need to know whether either facility hits its occupancy targets. Same boom. 3 different businesses. The operator's outcome depends on timing, grid access, and whether the tenant is still there when everything finally comes online. The input seller's outcome depends on demand, and for now, demand is still there. So what are you actually running if you own a data center? A power arbitrage business. You buy electricity wholesale, resell it wrapped in uptime guarantees, cooling systems, and redundancy at a significant premium to companies that cannot manage any of this themselves. The margin lives in the gap between what you pay the utility and what you charge the tenant. That gap is real. But it only exists if you solve the power problem before you poured the foundation. Not after. Not while you wait in the queue. Before. Site selection is not a real estate decision. It is a grid access decision. Everything else, the building, the hardware, the tenant list, comes second to one question. Can you get the power at the price you modeled before your debt service starts running? The operators who asked that question in 2010 are collecting the answer today. Here is the final operator rule. You are not building a data center. You are buying a place in a 10-year utility queue with a $2 billion waiting room. Get in early, and it is the best landlord business on earth. Get in late, and you are paying rent on a building your tenants cannot move into yet. Your electricity bill has been paying for this infrastructure, not through a subscription, not through a service fee, but quietly, through utility rates that fund the grid upgrades that make these buildings possible. Virginia is now pushing that cost back toward the data centers themselves. If your electricity bill is helping build the next data center, who should really be paying for the power? Tell me below. If you want to understand the real economics behind the infrastructure that runs the modern world, subscribe. New video every week.